We are very fortunate today to have one of the best analysts on the planet with us, Luke Roman. He's the editor, founder of From the Forest to the Trees, where he'll give you the big picture of what's going on. He's been very right. The things that Luke and I talked about a few years ago, I'm seeing manifest on my screen. Now, Luke, great to have you with me and talked to you a few weeks ago. New event in the Middle East with another theater of war. So we have one in Europe. Now we have one in the Middle East. The only thing that's missing is Asia to complete the trifecta.
Sadly, it
Yeah.
is. It's at a time when we need less inflation. War is inflationary, as Zoltan Pozsar wrote in 2022, and uh, it's not helpful. It is a disruption to markets. It's a disruption potentially to trade. It's inflationary at a time when more inflation will be disruptive.
I've talked to some energy people, and I know that's a big part of your narrative. Peak supply in oil, and they're very sanguine, Luke, about this. They're saying no, no, there won't be an embargo. Um, the Straits of Hormuz will remain open. And that type of complacency makes me kind of nervous. Now, I know people that bought WTI on the invasion, they lost money because we had a little break after that, but I think they're out now because that trade didn't work for them. But I look at this area here, low 80s, upper 70s. They look like lotto tickets to me to be buying long-term calls because um, if Hezbollah opens up another front, Iran and the U.S. are being pretty bellicose with each other.
Yeah, I mean, there's obviously a risk to escalation. I would defer to others on that. For me, I would. The Biden administration came out and said we're buying oil at 79 to refill the SPR. I look at it and just go, okay, well, there's my there's my downside.
Yeah.
Um,
Okay.
and then to your point, if things get chippier, um, you've got an upside. And ultimately, it's I think ultimately it's a way in which the bond market may prevent the war from getting worse in some way, perhaps, because ultimately the only way the U.S. can afford it is if the Fed goes back to QE with oil at 83 and gold at 2000
Yeah.
and
And the dollar pressing new
and
recovery
the
highs. Yeah.
the dollar pressing 106 or
Yeah.
107. The Fed would have to basically finance the war, like they financed the COVID war, right? That was
Okay.
compared to a war. So that you'd have to basically go back to what the Fed did in 2020 if this thing really gets hot. And maybe that's what happens, but that sets you up as you look at oil and you go, okay, well, the US government is going to buy it at 79 and then I have a call option. That's
Yeah.
interesting on an upside
I, I'm.
downside basis.
Are you sure they have the? It's in the budget. Don't they have to? Because when oil was in the low 60s, they couldn't fill up the SPR because they were having trouble putting together a budget. So there wasn't the money to do it. They have the money now to start buying WTI at
That's
79?
that's a good question. That might have been during the debt ceiling. I don't know the answer to
Yeah,
that.
yeah.
I know they lifted the debt ceiling, so maybe there's no debt ceiling, so maybe they can. But that's a great point. I don't know.
Okay. So that's a great segue. You bring up the Fed having to finance everything through QE. Say, for example, we have an oil shock, and I've been told every major recession, there's been an oil shock prior to the recession. So this one looks like it could be shaping up to be the mother of all. If the Iranians can choke off the Strait of Hormuz, I've heard people say WTI could be $200-300 on an event like that.
Yeah, I wouldn't. I wouldn't
Yeah,
see why not. I mean, let's put it this way. It would certainly strike me as possible. Like if you said, "Hey, it's cut off, and now there's a war, and the U.S. is sending a carrier group over there to try to free it, and
they're
oil's
there.
200," I'd be like, "Okay, yeah, I could see how that could happen." I mean, let's hope that doesn't happen, but
Yeah,
that would be extremely problematic for and disruptive for markets. I mean, you'd want to own oil and gold and probably Bitcoin and probably energy names, but not a lot
yeah,
else. I mean, it's industrial names, but
yeah. Well, I'm not a geo politics major, but I have followed Netanyahu through his career, and it always seemed to me his number one mission was to have military conflict and neutralize Iran because they want to wipe Israel off the face of the earth. So he's getting late in his career if he's going to make the move, just like Putin late in his career started making these moves. Netanyahu, it could be a possibility. I want to move to treasuries. There's a little relief today because of the package comments, temporary.
yeah, I think it's probably temporary. I think what I've read so far of this the refunding documents or the TBAC's plans. When you read the report that just came out in terms of the recommendations, is hey, issue more at the short end in the liquid
Right,
side of the market. You know, it's not exactly comforting in terms of the liquidity at the long end. And
right.
particularly when you get into the nuts and bolts of that TBAC document, which is foreigners aren't buying anymore.
Okay. Hedge
They should they
funds.
actually it's hedge funds, which is exactly what we've been right. It's as a good friend of mine pinged me, we were talking about it. He goes, they're saying the quiet part out loud. Like
Yeah, yeah.
it's they've got a supply demand problem, and so that is and there it's you know
Well, that's,
they're doing what they can.
yeah. So is that exemplified for the first time ever in modern market history for emerging market debt for their yields to be lower than the US is a statement in itself, isn't it?
Oh, I absolutely think it's a statement, and I think it's a statement that there's this view that the U.S. can raise rates and weaponize the dollar. We can run what was called the Soros imperial dollar, right? This virtuous dollar cycle. And the problem is that the Fed, U.S. policymakers, began running that imperial dollar cycle, higher deficit. In short, the Soros imperial dollar is just run big deficits and run tighter monetary policy, and the dollar will go up.
Okay. Is that
And
what you
that
go ahead? Is that what you mean by when you talk about fiscal dominance?
No, that's a different topic, but this is really fiscal dominance is a outcome of this that they didn't expect. In other words, this is something they did in the 80s, early 80s, right? So
Yeah.
the US ran big deficits under Reagan, and the Fed under Volcker hiked rates, and the dollar skyrocketed. And it brought it brought the pain to the entire emerging market world. And there's a view that, hey, if we raise rates, we can bring the pain to China, and we can do the same thing we did in the 80s. And the problem is that these policymakers either didn't realize or simply chose to ignore because it hurt their case the very different ways, or the ways that the setup is very different now than the early 80s, right? So debt to
Oh yeah.
GDP is 120%. It was
Yeah.
37% when they did it in the
Yeah.
80s. It's deficits are at 8.5, eight, and it was at 4.5 when they at the worst when they did it in the 80s. And so, and then most importantly, the net international investment position was positive 3.5% of GDP in 1984. It's negative 65% of GDP when they started running this playbook last year. And that is when you ask, why are to me, that's why I thought the rates in emerging markets being above Treasury yield is so important. When they ran this Soros imperial dollar cycle in the early 80s, it was a virtuous cycle. Capital came back,
Right.
dollar went up, inflation went down, capital flowed here. Well, now the capital's already here and they have dollar denominated debt. So the capital flow is literally 180 degrees different to what happened in 1980 and at 80 to 85. Because the net international investment position is negative 65%, not positive 3.5. Back in 80 to 84, the capital came back here. Now, what happens? The dollar goes up, the capital leaves here because they need to sell their debt to sell their treasury holdings. They, the foreigners, emerging markets, to raise dollars to defend their currencies. And so what happens when that happens is eventually you see Treasury yielding more than emerging markets. It makes perfect sense. They're running current account surpluses. They have lower debt. And they've got a ton of treasuries they can sell, and they're selling them. And as we were
even Greece is priced underneath the U.S. Figure that one out.
Yeah, they're actually, once you start having a world where commodities are priced in multiple currencies,
yeah,
debt starts to move to trade on balance of payments fundamentals because you can shift among the currencies. So it's still in the very early days, but if you have a world that is shifting towards more balanced trading on more balance of payments fundamentals, which it is, as long as you have multi-currency commodity pricing, then the U.S. is no longer the cleanest dirty shirt. It's the dirtiest dirty shirt. We've got the biggest twin deficits of all, followed by our friends, the U.K. Okay. And, the Japanese have their own problems. But again, the Japanese can say, we need to defend the yen, sell my treasuries, buy dollars, sell dollars, buy yen, and do that for a while into a treasury market that we just said isn't that liquid. It's not that liquid at the long end. Otherwise, the treasury would be issuing out there.
Okay, great point. So you bring up the Fed. Here we are today. There used to be a narrative that was floating around the markets, Luke, that Paul wanted a lower stock market. He wanted a decline in the stock market to get a negative wealth effect. And I think today really has a chance to prove himself because up until the last couple of days, the market was on its back foot. I think we're back about 4,200 in the S&Ps right now. But do you believe, because the economy is so financialized to the market, that Powell is going to take the opportunity today to say higher for longer again during the presser and sound as hawkish as he did at the last meeting? Or will he be reserved because of what's happening? Maybe the Middle East will give him an excuse.
I don't have a strong feeling on it. Gun to my head, I think he pauses. I don't, and the reason I think that is I think what happened in the treasury market in August, September, and through the first couple days of October scared the hell out of all of them. To be clear, the United States Treasury market crashed at the long end. It fell 20% in less than 2 months.
Yeah.
And I think that surprised. I think they wanted maybe a little higher long end. I don't think they wanted the Treasury market to crash. And I think that scared them. And the reason I think that scared them is because on October 3rd, the Treasury Volatility Index hit 141, which it had hit 140 in March, and the Fed was in with the BTFP now.
Right, during the banking crisis.
During the banking crisis, September 2022, gilt crisis.
Yeah.
The move index hit 150, 160. The Fed didn't do anything, but Treasury, TGA, ran down the TGA, weakened the dollar by 15% in 4 months, which is an enormous move in the dollar in such a compressed period of time. They were on it now. So we see the move index hit 141 in October, on October 3 of this year, going higher. And what do we see? In the next 8 trading days, we see 7 different Fed officials come out and
Yeah.
say basically the exact same thing, which is the bond market's doing our work for us. The bond market's doing our work for us. I think there were alarm bells going off at the Fed with what was happening in the Treasury market. They were losing control of the Treasury market. Again, the creator of the MOVE Index, Harley Bassman, has said at 150, it's a sign that the Fed is losing control of the Treasury market. And that's why I think the Fed will probably stand pat. Is I think they had a come to Jesus about treasuries over the 2 months of August, September, and into early October that I don't think they want to repeat, because
Another
if they
20% would be the death knell.
then once they, and if they really lose control, they're in, now all of a sudden they're going to need to be doing massive amounts of QE, which they will insist isn't QE. It's market functioning purchases of treasuries, or it's BTFP, or it's not QE, or whatever. Like, the market's not going to care. It's going to be liquidity. And ultimately, that's what they need. So they're trying to ride 2 horses with one ass, right? They're trying to jawbone down the dollar and support the treasury market while also being tough on inflation, getting asset prices down. You can't do both. So I like I said, that's why I don't have like a huge strong feeling on the short term of it. I think they're probably done. But I think, gun to my head, I think he probably pauses again today.
Okay.
And I yeah.
And probably not even bring up that we may still raise one more time in December.
Maybe he does, but I don't think he would. Like, I think he will probably say that because, again, that helps him ride 2 horses with one ass and
Yeah.
maintain some credibility.
Yeah.
But I think December is going to come, and he won't.
Okay. Well, if that's going to happen, we could have the correction in the stock market about 10%. Do you think it's a correction or a major top? Because I still think, despite the bounce, we still have mega cap tech compared to yields really being stretched and overvalued still, in my view.
I don't disagree on mega cap tech B with the valuations, etc. The wild card in all of this to me is stocks versus bonds, which is to say the bond market's the sucker at the card table. The only way the U.S. can square the circle with its fiscal math is to have a sustained period of negative real interest rates, basically. And the bond market's $130 trillion, something like that, and the stock market's, I don't know, 50, 60 trillion. And so I just think we are in the very early days of a secular shift that is sort of like Argentina with U.S. characteristics, which is to say, the bond market, the dollar bond market, I think has begun, and I think will continue to squeeze out of bonds into stocks, because the U.S. fiscal situation is so dire that the only way over time to make the math work is to print money, weaken the dollar serially, as it's been doing. And you can see this process having begun. It's really accelerated in the last year. If you look at the chart of S&P 500 over TLT,
It's
it's
amazing.
steady and up, and it's gone vertical in the last year or so with the crash in treasuries. But yeah, that to me, I think, is one of the big gears, or one of the big release valves, not one of the big gears, but one of the big release valves, where the fiscal situation of the US, I think, is the dominant big gear, along with the fact that global central banks and foreigners more broadly are just not participating unless the dollar's low enough. And so if you say, well, if
Right.
foreigners aren't going to buy enough unless the dollar's low enough, why do you buy bonds?
So
What's,
it's the Fed needs a turn in the dollar to support the bond market.
correct?
Okay, and we're looking at euro around 105, 104. I have 102 as a number I've been waiting for a long time. It's about 61.8. And I also like the Aussie around 62 cents. I've been waiting for about 109 in the Dixie, I don't know if we're going to get it, but do you have, I know that you're hedging the whole financial situation with gold and with Bitcoin, which I'm going to ask you about. Any fiats that you would diversify out of from the dollar, or you don't trust any of them?
For me, I don't spend enough time trying to be tactical with, right? Like I can
Okay.
either write as much as I write or I can tactically trade, but I can't do both. And so I prefer to write. And quite
You're
frankly,
you're
I think I'm
smart. I
better.
tried. You're smart. I tried.
I think I'm
Anyway,
better at it, but the way I think about fiats overall, and I think is the way most investors, most individual investors should think about it, is um, basically they're they're sort of like the wooden nickel tokens, and
yeah,
like they're used to be spent for other assets that better hold value um, in what is going to happen in a very strong likelihood, given the global sovereign debt bubble bursting and that it is centered in the West. And basically, it is, I can, at the moment, gun to my head, I would expect, I'd be a better buyer of euro and I'd be a better buyer of Aussie dollar. I'd be a better buyer of the Swiss franc against the dollar. But I don't,
yeah,
the levels technically you've talked about, I've
yeah.
seen that makes sense to me, but um it's such a big the global sovereign debt and the Western sovereign debt issue is so big, and it will have to be fixed with money printing. I just prefer to sort of play it unlevered and not try to get too cute.
Okay. Now we've had this huge run in gold, Luke, and very powerful rally in a very short period of time. I believe I caught a tweet of yours that said you could gold go back to 1800, and you said sure. Under what circumstances would it be a continuation move in the dollar, a blow off to the upside in the dollar, or perhaps Fed losing control of the bond market and rates just run so high they suck money off Mars, and we have a liquidity type crisis where all markets go down? Is that it? That could
Yeah,
bring gold back down?
yeah, I would think it'd be one of two things. You'd need some sort of severe dollar liquidity crisis, right? So you get, the 10-year yield spikes from 4.9 to 6 or 6.5,
Okay.
and that type of action, in a short period of time, that type of action, I think, would probably create market dislocations. Liquidity sucks. That the other thing that would make me bearish gold, and probably more so than just 1800, would be is if the U.S. government comes out and says, we're pulling out of Ukraine, we're pulling out of Israel, the 125 bases or the whatever, however many bases in 120 countries, whatever we have. We're cutting the defense budget by 70%. We're bringing all the boys home. Social Security, we've restructured, and we're going to cut it by 50% starting tomorrow. Sorry, baby boomers. And we're also going to raise rates another 100 basis points. If they did that, like
Yeah.
I would be very bearish gold. I
That's not going to
ascribe
happen.
I had virtually zero odds to that happening.
Yeah.
But more likely, from a tactical standpoint, could you get it downside to 1800 on a real crash? Yeah, you probably could. Do I care? No,
Yeah. Okay. And
because we all know
Bitcoin,
what the response is going to be.
right. And Bitcoin, even without the response, and you know how people used to compare Bitcoin to risk, and we had that pretty severe sell-off in equities, and Bitcoin went the other way. What was behind it? And should you be patient and wait for a pullback to buy Bitcoin, or just get in? I've been waiting for 20,000. Will I wait the rest of my life to see 20,000 again?
You might. Uh, I don't know why it reacted that way, but I noticed that it did react that way. Right.
Yeah.
This was sort of, beta levered NASDAQ. And then the NASDAQ went down and it went
Oh,
down a lot less or didn't go down. And,
yeah.
it's, one of my best relationships on Wall Street always says when you see these macro relationships change or shift or diverge, that's an important signal to take note of.
Right.
Why do I think it was happening? I think I think it happened the same reason that we've seen gold diverge from inverted US real rates, which is more and more money is saying, yes, gold could go to 1800. Yes, Bitcoin could go to 25 in a crisis. However, in a crisis, the US deficit is going to blow out to, let's just do the math I've highlighted before, right? So we're at 8% of GDP deficit now. The last three recessions have seen the US deficit go up by 600 basis points, 800 basis points, and 1,200 basis points of GDP in 01, 08, 20. Let's set the 20 aside because it was a pandemic, it was sort of unique. Let's just say it goes up 6 to 8 points of GDP in a recession. That means you're going to have a deficit of 14 to 16% of GDP. And a twin deficit nation in a recession with deficit of 14 to 16% of GDP, you do not buy the sovereign debt for safety. That's not where you go for safety in those situations. You go to gold, you go to the dollar. Well, this is the dollar. So where do you go? You go to gold, you go to Bitcoin. And I think there's a growing number of investors saying, you know what? I don't know when, but I know this iteration of the game is going to result in this outcome, which is deficit goes, basically either they're going to preempt the recession because they don't want to see the deficit do that, or if the deficit does that, you're going to see a bond market calamity in the middle of a recession, which happens all the time in places like Argentina and Brazil
Yeah,
and
people don't
Turkey.
understand. They think
Yeah.
rates only go up because of economic strength or the Fed. Rates can go up just because of supply and not enough liquidity to buy it. That's what these movies roll over. And
Yep.
gosh, I read a book by Martin Weiss in the 70s called The Great Money Panic, and he talks about bill rates going to 20%, not because there's economic strength, it's just the cost of continually rolling them over that rates went up that way. So and it's usually accompanied by a currency crisis, right?
It's usually accompanied by a currency crisis, and that's sort of, there was a chart we highlighted from James Turk, or an article we highlighted from James Turk. We've replicated the data. The U.S. insolvency ratio. Insolvency ratio is just gross interest over tax receipts, and it's going to be 30% next year. And and that's assuming really no recession. So you can sort of, like, the last time it was there, I mean, what James Turk said about it is, that's once you get to 30% on the insolvency ratio, that's usually when you get monetary crises and you get debt crises and you get currency crises. And so, and I think, back to your point about Bitcoin and et cetera, like, I think there's enough people saying, okay, I don't know the exact timing.
Yeah.
But I see all of these signals, and I know how this is going to go when it goes. And it's no longer, with these ratios being here, we're no longer talking about 2 and 3 and 5 and 10 years out. We're now talking about, we're getting down to investable time horizons, next 6, 12, 18 months. And I think you're starting to see that play out in markets because big money needs time to move.
Well, our watchman, Luke Roman, I recommend that people go to your website and follow your work, Luke. I know that every time I have a talk with you, I feel more calm because you simplify solutions in a complex time, and you're definitely a big part of my intelligence gathering. I appreciate your work. And I
Thank
have
you.
a lot of respect for what you do, Luke.
Well, thank
Thank
you
you
very
for
much.
thank you for being a watchman for all of us that follow you.
No, I appreciate that. Thanks for having me on. It's been great
All
being here.
right.
I enjoyed it.
All right. So go to FFTT LLC, check out Luke's work, and I don't think that you're going to regret having the big picture and seeing the forest from the trees with Luke. Thank you, Luke.
All right. Thanks, Deb.
All right. That's a wrap, everyone. Hope you enjoyed Luke. Follow him, and I'll see everyone tomorrow. Good hunting, and don't just count your pips, count your blessings. Adios. Thank you, buddy.
Thank you.
I'll see you, man.